live from Music City, Nashville, Tennessee. This is your motivational, sensational, inspirational, educational, aspirational, international, keenly awaited, daily created, highly anticipated edition of the Afternoon Swing Trading Floor with your humble host, Jeremy Alexander Newsome, with another daily dose of mentally delicious brain food, reminding each of you to love life, live life, and trade it. Welcome to Monday, Mentorship Monday, actually, in the building. Tony's here, Wade's here, Yates, Sharon Baldwin, Scott McKay, Robin, Nitro, Mike K, Joseph Smith III, Joan, Garon, Jill, Jean, Falco, Webb, Mark, Bob, the Sergeant's here. I love it. What a wonderful time that we're going to be able to spend together. So we have Mentorship Monday is today. And what I will do is just kind of briefly review the markets, kind of go through some just really quick stocks, talk about what we wanted to talk about, and then that's pretty much it. So my goal today is to discuss a little bit about credit spreads, debit spreads, when you would do one of the two versus each other, when you would do just a naked option versus one of these, what times would you do them, kind of just discussing how they work in general. A lot of people had some requests about those, and we can easily cover those today. Before we dive in, though, just some really quick housekeeping. The U.S. markets are closed on Wednesday. So in honor of the passing of the 41st President of the United States of America, U.S. markets are closed on Wednesday, so no need to be here, except since I was not planning on taking a vacation, I'm all about taking days off. I'm all for that, but this particular time was not one of those situations where I really wanted to take anything off. In fact, actually it's already gone. I was already planning on just trading and working all day with all of you anyway. So what I went ahead and did is created a back trading webinar that we're all going to do the same time together on Wednesday. So let me post that link in the chat pane. For those watching this recording, it's in your inbox in the same exact email that you open this. You'll have that recording link, the link to the session for the back trading. And if you can't find it, email it to me. I'll send it to you. And I'll post it on Slack. I'm going to send it to everybody, so everyone's going to get a chance to be there. It's not just those in the trading room, but I'll invite the whole real-life trading community, everyone out there on the internet. We'll just have a really good back trading session. People love back trading, so I love it. It's always a great place to grow. My goal for December is to hit 15 Rs. December is usually the most profitable month of the year for me. Who is going to try to hit that goal with me? Who wants to do it? I know Angela's in. Robert Falco already said that he's going to do it. Bob says he's going to do it. Tony's going to do it. Wonderful. It's going to be hard. It's not going to be easy, but let's at least stretch ourselves. Worst case, we don't hit it. Right? That's worst case scenario. But let's go for it. Let's try. Let's find some really good trades. Let's put in some back trading hours. Here's a true statement, folks. If you want to do something you've never done, you have to do something you've never done. Right? If you want something you've never had, do something you've never done. And let's do it. December will be the month. We'll make it happen. I'm not going to include any kind of cryptos or anything like that. It's just going to be, at this point for me, swing trading. I will include futures for December and day trading. Angela said, I'm in for 21R. All right, girl. I see you over there. That's cool. The Baldwins are in. Wonderful. Okay, so that's just one of the things that let's just do our best. If we the best way to do that, realistically, the best way to hit some really strong targets like that is taking a lot of profit off the table when you have it, locking it in, finding any reason to take the gain if you need to, and then holding the winners. All you need is one or two really strong winners. and just dialing down those time frames and really trying our absolute best. Sometimes you have to take a lot of trades. That's okay. Don't be afraid. Lose small, win big, and just lock in the games when they're there. So 15, we're going to make it happen. Charles says there is no try, only do or do not. Paraphrasing you. Absolutely. So let's talk a little bit about the spiders and what we had today. Obvious retest gap today, right? Very, very obvious fading opportunity. And you had just tons of white candles gapping up. What I am looking for is I'm going to keep an eye out for the SPY to continue to roll over. It doesn't have to occur. And I'm actually fine for it to continue higher from here. But I will watch it just in case we start taking out specifically these lows on the SPY. And I will talk about my, my trade on futures as well. But here was the support that I'm really watching. So this is the 278.69 level. So if I hop over to the E-minis, which this data is delayed by 15 minutes, I'm just kind of watching this hammer. So these two volume candles right here is what I'm really watching for to see if we can kind of hang through. And if we break those down, tomorrow morning. I don't think it's going to happen overnight. It certainly could. But I'm kind of expecting a little bit of a gap down tomorrow morning, potentially. And then I'll be looking for a continuation short. Here's the daily chart on ES. You got this nice high wave candle, right? It's occurring at a resistance. I will say that if we do start showing signs of bullishness and we don't break down, I'm okay to go short-term bullish for 2 or 3 days. And let's just ride up this wave, let the breakout occur, let all the newbies hop on, and then we can sell to them. So that's the ES that we're looking at. And here's, again, the SPY. I do think this gap eventually will fill. I don't know when, but it will. It will fill. And, I said that with the same degree of certainty I said about this gap down here filling and this one as well. So just looking for maybe a gap down, maybe a little bit of weakness tomorrow, and just like a small rotational lower over the next 2 to 3 days on the SPY. And then, of course, we could bounce off the 200. We by no means have to rotate all the way back down. This is cool. But what we did do today is create a nice lower shadow. That's why I'm saying we can bounce today, right? That's absolutely fine. So we can bounce higher. We've retested. That's all we theoretically need to do. But if we gap down and start taking out the low of this candle, yeah, we're going to be peeling back some lower moves and getting some dip buying opportunities. So this low is going to be really fun, and this high is going to be really fun. So if you turn in the hourly chart, you turn on the extended hours, I don't really foresee us taking out and making new highs on the SPY. So that's going to kind of be like my stop area that I'm looking for. And there are other broader markets. Here's the Qs. The Qs are also up pretty big, but they all look relatively identical. The IWM, right? Nice little lower shadow. So it retested. It got a little bit of a bounce. And, you got that inverted head and shoulders pattern. So, again, I'm okay if we do go higher. That's okay. Not stressed about that at all. Just looking for a little bit of a fade on SPY. But the IWM has actually filled that gap, and this is a beautiful, beautiful candle. So there's no need, if we do break bullish, don't be afraid of it, is what I'm saying. We can easily make some higher highs going forward with this particular candle. Then here's the Dow Jones, which is the DIA. And the DIA is also a pretty cute candle. Now, this actually brings up a good point, and this question was proposed by a real-life trader, and I said, hey, that's a great question to bring up during a Mentorship Monday. The question is, when would you do a debit spread versus a credit spread? And if you do have a debit spread, what is a debit spread? So let's kind of discuss that. Before we dive immensely into it, I do have some articles bull call spread on real life trading. So these were created a while ago. I think it's called 5 points of a bull call spread, or maybe not. Real life trading. I didn't think I'd have to type all that in. Okay. So I guess let's go to reallifetrading.com. So I guess I'm not getting the name right. I thought that's what it was. The reason I'm bringing this up is I do have some articles where you're more than welcome to pop over and kind of check these out. So if I just type in debit spread, I'm interested to see what comes up. Debit spread? No? Okay. So if I type in bull call, nothing. Now I have to try to track this down. So 5 points of a bull call spread, or bull put spread, we know that. Let me just type in 5 points. I think they're all spelled. Yeah, 5 points of a bear call. So I did bear call and I did bear put. I didn't do bull put or bull call. That's why. Okay, looks like it's time to write that one down then. Bull call spread article. All right. So these are back in the day, but it's very similar to the bear put spread. So let's go ahead and throw these in the chat pane just in case you want to check them out. There we go. But here's pretty much what you're working with. A debit spread, and traders really do like these a lot. I personally do tons of debit spreads, and I'll explain why. But a debit spread is a limited risk, limited return strategy. Limited risk, limited return. It requires less option approval than credit spreads. Okay? Credit spreads or option selling require margin. Debit spreads do not. So if you're ever interested in doing some fun, kind of cool option strategies, this is probably going to be one that you try out, which would be a debit spread. And the reason is because it doesn't require any margin and you're able to kind of do some fun-filled things with your option. The most important thing to consider is the expiration. Important thing to consider is expiration. If your sold call expires at a different time than your long call, you could have margin requirements or get exercised. So I'm just saying that to kind of cover the basis, and I'll explain the expirations as well. But most of the time, there are realistically two types of debit spreads. And I'll say two. You have what's called, I would just say a regular, and then you can have a calendar, also known as a diagonal. And these are different expiration dates. So these are a little bit more interesting. There's another type, obviously, well, there's a few other types. One is called a ratio, which you just do different strikes, different amount of contracts. So we're going to talk about those as well, just in case. We'll kind of bring those up. But those are the two types of debit spreads. You have a regular one, which both expirations are the exact same, and then you have a calendar, which is different expiration dates. And then a ratio just means different amount of strike prices. So let's go practice one really quick on the SPY. So if we're at a resistance and we think we're going to roll over, there are a few things we can do, obviously. But if we wanted to buy a put, let's say we wanted to buy a 280 regular December put on the SPY. Okay, so a 280 regular old December, which is December 21st, 280 is pretty much at the money. That would cost you $4.72. Okay, so 280 regular December, so just December 21st, would cost you $4.72 per contract. All right, so $472 a contract. Now, that is your maximum risk. Okay, so if SPY runs to the moon, your maximum risk is $472 per contract. So if you buy one of them and SPY does this, you're going to lose $472. If obviously you hold all the way to expiration, because again, at any point in time, you can buy that, sell that back if you would like to. I think we all know that at this point. Now, if you want, you could sell a 268 December 21st put. Now, why would you do that? So a 268 put right now is trading for about $1.15. So what that means is on this particular trade, you have the ability of reducing your cost basis. So if your original cost basis is $4.72, if you sell a 268 put, what you're doing is you're creating what's referred to as a bear put spread. And the reason it's called a bear put spread is because it will make money if the stock goes down. And only if the stock goes down. Okay, so if the stock goes up, you're going to lose money. If the stock goes sideways, you're going to lose money. Only if the stock goes down. So it is a bearish position. It is a bear put spread. Now, what's cool about this trade is if you buy a 280 for $4.72 and sell the 268 for $1.15, you have a total debit of $3.57. Now, a total debit of $3.57, your max reward is 280 minus 268 minus 357. So I'm going to pause for a moment. Does everyone know where I'm getting those numbers from? All right, so 280 is the put that we purchased. 268 is the put that we sold. 357 would be the debit between the two numbers. That would be your total cost, the 357. So 280 minus 268 minus 357, which should give you $8.43. So you're risking $3.57 to make $8.43. Not bad. It's about a 1 to 2 risk-reward ratio. It's actually a little bit better than a 1 to 2 risk-reward ratio. The way you make all of the money on this trade is if SPY trades down all the way to 268. Now, since these options have the exact same expiration, you can hold this all the way to expiration, and if SPY closed below 268, it has been my experience, if they have the exact same expiration, the spread will just offset itself. Meaning there would be no reason for you to sell SPY at 280. Because that's what you would do if you had a regular long put and then expired in the money, you would sell your shares at 280. Now, the difference between doing a bear call spread is a bear call is going to be also a bearish position. But if you did that, let's just say up here, and you hopped over to SPY, and you're looking at, okay, what was that, a 295? So 295, 296, there is no money up here. There's none. And that's one of the downsides is if the VIX is not high, there very, very rarely is a solid amount of premium to do a double-sided option. Double-sided or double-legged option, meaning you have both, you have two different calls. So because I think most of us know with the bear call spread, you would, sell to open the 295, 295, and you would buy to open BTO, you buy to open the 294. Now, you could do a closer spread. So for example, if you came all the way down here and said, all right, let me do a 285, where I sell to open the 285, and then I'm going to buy to open the 286. If you did that, that is a bear call spread. And if you did that for December 21st, let's see how much you would bring in. You'd sell to open the 285 for $1.31. Let's do that somewhere else. So you'd sell to open the 285 for $1.31. And you buy to open the 286 for $1.05, which means that you would make 25 cents. So $1.31 minus $1.05, you bring in 26 cents of credit. And that money is yours, okay? That money is yours if the stock stays below 285. So these are call options. So these are calls. So the ones in blue is you're buying puts and then you're selling a put against it. The one in black is you're selling calls. So the blue is buying puts, the black text is selling calls. And the downside of this particular credit spread is, let's say you wanted to make $1,000. All right, if you wanted to do $1,000, you'd have to do 10 contracts plus 10 contracts. So that would cost you, depends on your commissions, but about 20 bucks, give or take. And if you're doing that particular situation, what your goal and objective at that point is, obviously your plan is for these 10 contracts to expire worthless. You want the stock to trade down and roll over. But if you wanted to make $1,000, if you wanted to make $1,000, you'd actually have to do even more contracts because you're only getting 26 cents of credit, which that's $26 per contract, right? $26 per contract. So if you did 10 contracts, that's only $260 of credit. So if you wanted to make $1,000 on this trade, you'd have to get into 40 contracts on each side. 40 contracts. And that would cost you $40 for one option, $40 for the other option if you're, $10 minimum and, $1 per contract trade. And you would be making $1,000 minus the commissions. And the way you make the money is as long as SPY stays below 285. But you have to put up a lot of margin in order to do that. So in order to make $1,000, you'd actually have to put up about $4,000 of margin. because I was talking about 40 contracts, right? So 40 contracts, if you want to do the math, it's very, 40 times 100 is 4,000 times 26 cents is $1,040. So you'd have to put up $4,000 of margin in order to make $1,000 on this particular trade. And if you wanted the same exact result for the debit spread, since your maximum risk is $357 and your maximum reward is $843, the difference of that is about $500. You'd really only have to buy approximately 2 contracts in order to achieve the same result. So your commissions are much less, and the amount of contracts are much less. So why would anyone do a credit spread versus a directional debit spread? Well, in my personal opinion, credit spreads are designed for traders who have larger accounts. Credit spreads are designed for traders who have larger accounts. So let's say, I really would say 50,000 plus. 50,000 plus, and the reason that they're designed for traders with larger accounts is because they want to be able to tie up more margin and use more capital. In this particular debit spread, right? In this debit spread up here, your risk is $357. That person very well might not want to tie up 10 contracts worth of that particular trade. And if they wanted to do 2 contracts of the 357 to achieve the desired result of $1,000, they would have to do so many different trades. Right? So think about it like that. They would have to do so many trades to achieve the same result. So you'd have to have like 9, if you want to make $9,000 a month, you'd have to have 9 of these same type of debit spreads all work out. So you'd have to have so many different trades. With a credit spread, you could do 1 trade, have these set up, have the margin applied. It's just 1 trade to manage. Obviously, it's multiple contracts, but it's just 1 trade. So those are some of the pros and cons, because if you're doing a credit spread, you're going to be spending more margin to make the same amount of money, but your probabilities also increase. So credit spreads are more, as actually Falco was saying this in the chat pane, credit spreads are more for smaller, high probability wins, and you're not going to have massive winners by any means. And so it can also come down to your personality type. What do you like? Do you like hitting home runs, or do you like hitting base wins? Credit spreads, the trap that most traders will fall into is they'll be promised something on the internet or on some type of random YouTube channel where they say, hey, if you have $100,000, you can do $10,000 a month with a $100,000 account using credit spreads. And the probabilities are extremely high in your favor. While that is mathematically accurate, remember, you're going to have to put up, if you have a $100,000 account, you'd have to do 10 different spreads, each with $10,000 of margin, each with 10% ROI on the spread, and all 10 of those would have to work in order for you to get your $10,000. So you'd have to soak up your entire account balance in order to achieve those results. Now, that doesn't mean that you can't do that if you have a larger account and you want to tie it all up, or you have a lot of money and you have a certain amount of money set aside for credit spreads. They can be quite conducive because you don't have to use as much margin if you wanted to do a naked option or a cash secured option. So many brokers do allow credit spreads in IRAs. So that can be kind of cool, and I know that to be the case because I've done it before in the past. So especially if it's an inherited IRA, right? Because credit spreads, they are a little bit different. You have the margin, you have a capped amount of risk at hand. We know the risk, and it's not, I mean, it's up to you, kind of your decision and your choice for how much margin you put out on a particular trade. So if you have a larger amount of money and you're doing credit spreads, that's absolutely fine. I know a lot of people who love doing credit spreads. If the options are correct and the premium is right, it can be a really fun place to do it. So for example, down here on the SPY, instead of doing option selling that's naked down here, you could have done a credit spread, which would have taken a lot less margin, but would have made you about the same amount of money. So, for example, if you sold one contract of the SPY down here, you probably would have brought in, at this particular point in time, maybe 258 bucks, approximately. If you sold a naked option, you probably would have brought in about 258 bucks. If you sold 10 contracts of the SPY, you could have made about 258 bucks. And this was with a credit spread. And the ironic part is 10 contracts on a credit spread of that magnitude, all right, would have had less margin requirements if you did, so if, let's say you did a 252, 251 bull put spread. Bull put spread. So you're selling the 252 and you're buying the 251. If you did 10 contracts of that, that's only $1,000 of margin. Right? That would have been it. So only $1,000 for total margin. That's all that would have been required for you to do that trade. And you could have made approximately $258 on that particular trade. Now, had you sold a 252 put that was naked or cash secured, I guess it technically doesn't matter, but let's say it was a naked put at $252, your margin requirement would have been about $4,080, just approximately. And that's just one contract. So one contract, even if it's a naked contract, you're going to bring in the exact same amount of money, but your margin is less. And again, that's one of the distinctions and differences between credit spreads and naked options. With a credit spread, you have some form of protection in case something just gets absolutely train wrecked, right? You have a cushion there. You have the ability to unravel if needed. So if SPY just absolutely tanked and broke through that level, you'd have a put that protects you. And your only risk is $1,000, right? You have a max cap, $1,000. Whereas on the SPY, if you do a naked put, theoretically, the option is unlimited. So what questions do I have so far? Only 30 minutes in, happy to pause. Bob says, so volatility is good, better premium gives better return, but your risk is stable. Bingo. And so that's, something that you want to consider. So when you're doing these credit spreads, you have the volatility is, when volatility is high, option selling is oftentimes the way to go. And so when volatility is really high, when people are really panicking, that's a great time to be looking for an option sale. But in this particular example, this exact example, this is a very specific and real life scenario. In this particular scenario, you could have made 258 bucks from either trade, the put sale or a credit spread. but one has downside capped risk, and your risk is stable. And you're technically getting better returns as well. Because if you make $258 risking $1,000, or if you make $258 with $4,000 of margin, which one has better return? And obviously the answer is $258 with $1,000 of margin, right? Because the $4,080 of margin is the put sale. So the advantage of these particular selling the option is you have a lot of things on your side. Options do decline in value. So you don't even have to be exactly correct. You just can't be wrong. So when you're doing a credit spread or an option sale, your goal is just to generally have a close approximation of what you think might happen. So someone pick a random day for me. And then I'll have someone pick a random stock and all that kind of good stuff. So someone pick a random day. Or everyone's typing in first. Just a random, good old, whatever day you want. We'll start with that first. February 22nd. Perfect. All right. So now, John D., I want you to pick a year for me. So pick a year, any year, doesn't really matter. 2016. All right. February 22nd, 2016. Joe, pick a stock for me. Joe, who's here? Pick a company for me, Joe. Pick a company, any company. McDonald's. So what I'm going to do is I'm going to go back on McDonald's. This is the daily chart. And I'm going to go to February 22nd, 2016. And without doing any analysis at all, as soon as I pull it up, I'm going to talk about an option and what you could have done. All right, so here we go. So I'm going to go to right here, present day, right here. All right, so I can't see anything to the right. So without any analysis, I'm going to look at McDonald's and I'm going to say, all right, based on what appears to be happening, if I do a little bit of a zoom out, okay, here's a little bit of a zoom out on McDonald's. You have some lower highs coming in, and we have some lower lows coming in. All right, and I would like to sell some options down here. I'd like to sell some options down here, and if I can find somebody, I'd like to sell some options up here. Or, so what I'm going to do is I'm going to type in two scenarios. So again, when you're practicing this, just go back in time and kind of practice what you would like to have done, because I think this has been a beautiful time for a bear put spread. And let's say we are in, so we're in December 2016. So I'm going to pick March. And then I'm going to do a 118 long put, and I'm going to do a 110 short put. So that's a bear put spread. And then also I'm going to come in here and type in a bear call spread, which I'm going to try to get above the all-time high. So it's going to be 125, 130 March bear call spread. And the biggest challenge, ladies and gentlemen, is right now, would you say McDonald's is at a high or a low? Lad says, you're in 2017, not 2016. Yes, I just had them pick a random day, so I would go back to that day, and then I'd cut off a certain portion so I couldn't see it anymore. Yep, so I'm almost getting into 2017. You're absolutely correct. John says you're at a high of range. Exactly. So I'm at a place where McDonald's has already moved high. So I'm not going to get into a bull put spread up here by any means, at least not yet. I want to wait for it to be at a low level, right? So when you sell puts, you want to sell them at a low level. When you buy calls, you want to buy calls at a low level. When you sell calls, you want to sell calls at a high level. And when you buy puts, you want to buy puts at a high level. Now, the good news is, with this really cute bullish move and this nice little flag pattern, if for some reason we close above here, I'll have a really good understanding and idea that we most likely will go higher, and then we'll be able to talk about what we do. So what's cool about this is, again, without any real analysis, you can just pull up a chart and go, okay, I'm going to practice. I'm going to practice this. So here we go. Next candle, we're down. All right, so we're down. John says, sell calls into strength, sell puts into weakness. Yes, sir, absolutely. So good breakdown. Again, if we close above 118, we'll know that something's kind of up. So what we're doing is we're more or less expecting the 110 bear put spread is capped at 110. So that's realistically your target. And remember, you don't necessarily have to know right now what the options prices would be. When you do these types of trades, you certainly can, right? You can pull up, think back, and you can look at it and find that out. But realistically, it's just better just to simply practice it and see how well you would have done. All right, look at that. Get some nice selling at the top of that resistance. Very pretty. So again, at this point, our bear call spread is probably profitable, and our bear put spread is probably profitable. Ladies and gentlemen, could we have done both of them? Yeah, we could have done both. I don't know what that's called necessarily, is if you do both of those. I'm sure there's probably a name for it. But anyway, really quick breakdown. Nice looking move. And we're getting a retracement. So like I said, that 110 is pretty much our target. So now I can hide this blue line because that was the day that we got into the trade. So now you have 3 or 4 bearish candles in a row. This retest makes sense. We have a little bit of a support line right about here. So we'll know if we break that support line, McDonald's should continue lower and the bear put spread should be just fine. What's interesting about the bear call spread up here, the March, is that's up at 125. So that's probably going to be okay unless McDonald's closes above 118 and just starts surging, which is certainly possible. But you can always practice your plan and figure out and determine when you would exit or buy to cover or buy to close that particular spread. Or at least, if anything, if you ever want to, you can always just simply buy to close. Oops, I think I stopped sharing for some reason. If you want to, you can always buy to close your short option because that's the one that with margin requirement. And then if you just hang on to the 130, maybe McDonald's will run all the way up until 130. Now, again, that particular plan is usually kind of rare because if you got into the trade, that often means that you got into it for a reason because you think it's going to go down. So if you sold this option, that option, the 125 call would have probably been, I'm just making up numbers, let's say $1.18. And the 130 would probably have been, I don't know, 95 cents. So now, 3 days later, the 125 call sale is probably worth, I don't know, 76 cents. And the 130 call is probably would have been worth 41 cents, something like that. So you'll kind of see, just roughly, if you end up buying back the short call, you still actually have money remaining in the 130 call at 41 cents. So you wouldn't really be making any money if you do something like that because you want to make sure you do the math. So if you sold when you originally sold and you brought in the difference, which in this scenario was 20, 3 cents. And 3 or 4 weeks later, the option premium is dropped, but not so significantly that you can actually make money, then you just kind of continue to hold it. Because there's nothing you can really do. You can't really sell, you know, make and buy it back and make any kind of real money. So next candle, kind of bouncing off the support. Next candle, good bounce off support. Next candle, a little bit of a bearish candle. A little bit of a bearish candle. Looks like a flag. John says, I'm more likely to buy back the short put as a means of doubling down on a pullback or a retest. So what John's mentioning is he's coming over here to this bear put spread. And he's saying if we got into this bear put, he would be buying back the short put, which is the 110, right? So that trade down and it bounced. So he's buying back the short put in hopes that it rolls over. Because remember, this is going to cap your gains at 110. If this thing just absolutely tanks and trades all the way into 104, you probably don't want your gains capped necessarily. So it's something that you really want to practice when you're doing debit spread versus credit spread, because again, there's pros and cons. With a credit spread, all you care is it just doesn't get up to 125. With a debit spread, you do need it to go down lower. So now we're trading at this beautiful resistance. We're back to this resistance. You can see it's now trading very nice and sideways. Really pretty candle. Super interesting volume came in here on the 20th of January. So super interesting volume on McDonald's. So if we break above this resistance, something is really up. Oh, nice. It was earnings. Okay, cool. So earnings gap down. Now, is this a strategy that you could do on earnings? Absolutely. I actually like debit spreads on earnings a lot. I do. I like because it gives you a way to cap your, to limit your investment. A lot of times, options are really expensive over earnings. And if you can sell an opposing option to bring in a little bit more premium, then it doesn't cost nearly as much. You can get a good gain if it gaps. So now, McDonald's is still trading sideways. The bear put spread, right? The 118, 110 is probably losing a little bit of money at this point. And this is a really interesting pennant pattern. So if we close above this pennant pattern, I'm thinking that this is going to start slowly breaking out any moment. So did not close. So I'm going to kind of scoot my trigger up. So we didn't close above there. So now I'm going to take it back up to where it was. All right, really interesting gap. I'm just sensing a breakout any day now. All right, there's a good close. A little bit of a higher high, a little bit of a gap down. This is probably the breakout right here, most likely. Now, in this scenario, again, what's happening at this point is your bear call spread is still probably profitable, but your bear put spread is not. Now, it was at one point, right? Down here, when it traded down to that support, that bear put spread was profitable. It wasn't as profitable as it could have been if it traded into 110. John says spreads with defined risk is much safer than naked puts or naked calls. Absolutely, because you have a very specific defined amount of how much you can lose. Totally correct. So that's the kind of difference between these two is both of these have a defined risk. So these are limited risk, limited return strategies. One happens to be directional and one happens to be non-directional. The non-directional is this up here. This to me looks like McDonald's is coiling and getting ready to break out. There it goes. That's the breakout. So again, it all started happening with this. This was the warning candle right here, right before earnings. A big volume spike with a pretty much doji candle. And then you got a gap down on earnings that had a hammer candle. Then you formed an inside candle. Then you formed another inside candle. And then obviously broke out. So I would probably just like to go long here on McDonald's. And if I had a bear call spread, 125, 130, I most likely would not unravel it, because unraveling a bear call spread at this price, 125, 130, McDonald's would have to trade all the way up to 130. Well, not quite, but it would have to trade pretty high for me to make money. In fact, this trade could still potentially be profitable. With 3 days in a row, most likely it might be a little red because you still have a month of time. But what I'm going to do for this example is actually show and just play it out all the way to March expiration, what would have happened in this scenario, which I think it probably will expire worthless, right? It most likely does expire worthless, the 125, 130. But if this is a real scenario, again, you have to go and look at the numbers, look at the premium, figure out, man, this looks like it's breaking out. I've been in it for a month and a half. I was in over earnings. You should be relatively profitable, because it still has to move real far for you to get to have any issue. I mean, it's got to get all the way above here and then some. So we've got a ways to go. I really wouldn't be worried about this particular trade, but I would like to get in long on an S-curve Mr. Squiggles pullback. I would like to get in bullish. So there's the gap up. There's a flag. That's a perfect flag on McDonald's. There's the breakout. So again, this particular pattern for me all kind of stems from that volume. Right before earnings, that volume spike was a big sign to me. And I really liked, as I'm looking at it, I like these candles that were making higher lows. We traded down to a support. And remember, at this point, this particular bear put spread is losing money. You're definitely down on it. And I like this candle. That was a bullish engulfing candle. I like this little flag pattern right here. I like these bullish candles. And again, I just like the fact that we traded right to that perfect trend line, threw in tons of volume, had a gap down on earnings, and then started rolling with it. All right, so we're going to get closer to the 125, 130. But again, I don't think that's going to be an issue, because that's going to be at above the all-time high for McDonald's. Beautiful long trade, though, if you did get a chance to go long. All right, so that would have worked out nice. That was a really good, quick little swing trade up into a resistance. Nice little breakout. Well done. If we took that bullish, again, could have taken it bullish with a directional call option, could have gone bullish with a bull call spread, could have sold puts, could have done a bull put spread, could have bought shares, all kinds of ways. So now, let's keep going forward day by day. So there's the dividend payment, there's a nice resistance, and there's a good gap. So right here, the high of this candle is 124.51. This is the 1st of March. You still have a full month to go, and it is now getting very close to your bear call spread. So this is when you have to start really figuring out a lot of work, and you have to understand, that's what we talked about back over here. You would have wanted to have known what's the right play. If you were profitable, you probably would have bought it back, as I mentioned. As it's dropping down here, we talked about you could have maybe bought it back. Maybe you bought back the short call and held on to the 130 call. Or in order to hedge your position, you could have bought a call option. Because again, a call option is going to go up as the stock's going to go up, and that will hedge your position as well. So I don't personally roll an option, because that usually just extends the pain, especially if it's just in a beautiful trend and you're like, man, this thing can just keep on going forever. So rolling an option would be when you simply buy the close, sell the close, do the exact same spread again, but for longer and farther out. So instead of doing March, you sell May or June or July. That would be rolling the option. Now, in this particular scenario, with this retest gap, it probably retests the next day. Yep, there's the retest. Right, so you're not too worried about 125, 120 right now, but it's only March 2nd. So there's your evening star reversal pattern, very small candle, very small doji. She's about to bounce at this point. Either direction, but I'm thinking it's probably gonna go higher. Resting, probably hanging out right at the 10. And the third Friday, I think, is coming up March 17th. You have one more day, boom. Oh man, that would have gotten grisly. That would have gotten real grisly. So tons of volume there on McDonald's. It did close at 130.21. So remember, when you do a spread like this, it has to close below the short put, or sorry, in this example, the short call. It did have a high of 124.50. So at one point during the day, you would have been a little red on this trade potentially, and you might have had to wait all the way into expiration for that to be a profitable trade. In fact, just from experience, these are the times where you most likely could have bought back the option for a profit. Sorry, the bear call spread. So I'll kind of highlight them for you. These in pink is probably the time you could have bought back a profit. And in blue, maybe you would have been able to buy it back. And then in red, that I'll show you, red would probably have been, there's some red in your account. And then green is when it would have expired worthless on that day. And that's with options. I mean, usually if you sell an option, you have a general idea of where you don't think the option or the stock will go. And that's why I just love selling options with the trend, because it's just so much easier. You know, if you pull up a really big trend, let's do one more example. So someone else give me another stock, any stock you want, doesn't really matter. We'll do one more example, just a nice long term. As soon as I pull it up, I'm gonna look for the trend. And we're gonna go pick a day as well. All right, Bob says Momo. Okay, so we're gonna go to Momo. And I'm gonna go to February 22nd, 2016. And this is as far as I can see to the right, which is December. And what I'm gonna do is zoom out a little bit, and I'm gonna go bullish. I'm gonna be doing a bullish trade. So we trade into a support, old resistance, new support, kind of right about here. And you have a support down here. And so as soon as I pulled up that trade, I was like, all right, I'm looking to go bullish with a bull put spread. If I'm doing a spread, that's what I'm looking at doing. And I'm gonna do it one of two ways. Right now you have a white candle, so I need to do it on a down day. Probably the next day, I have the ability to do a spread. And if I did a nice long-term spread, or if I did something like down here, it'd only be probably 12.50. So I'd have to do like a 12.50-10. If I did 5 months of time, I could just hop down here without really doing any analysis at all and just say, okay, I don't think Momo trades down to that price. And we can pull up all kinds of things, right? We can pull up our long-term moving averages, like, okay, there it is, bouncing off the 200. And you know there really won't be any issues to get into that particular spread. My friend Lad says, why do you wait for a down day? So you wait for a down day because you're going to get a lot more premium. So you want to sell puts on down days because you get better premium. There's a down day right there. And right towards the end of the day, if you were getting into that trade, you would have sold your puts on that day. At least. You could have waited for longer, but at least that day. Because you're going to get more premium. So again, just pulling up a chart, immediately looking for a trend. That's why I do like credit spreads. Because if you did a debit spread right here, even if you did a really good one, it may or may not work. Right? We don't know for sure that Momo is going to bounce. We also don't know for sure that Momo won't go down to 12.50. But the odds are more in our favor. Once we determine a trend, we have a general idea that it might be pulling back to a particular location. We can usually say pretty comfortably, yeah, I don't think it's going to go down that far. That's why I like going with the trend. So let me just press play, and we'll be able to see what Momo ended up doing. And again, I mentioned that was like an April option. Or, I'm sorry, I meant May. So we can see that buying off the 200, you could have done a debit spread, and the debit spread would have capped your risk. You could have done a credit spread, and a credit spread would have capped your risk. Both would have worked. You could have also bought shares, you could have also bought directional calls, all that good stuff. But right now is probably not a horrendous time to look into debit spreads because the VIX is actually pretty low. VIX is relatively low. It never made new highs, which was really interesting. With the market making new lows at one point, that's why I kind of thought the market would bounce, because the VIX just never really showed that much fear. So usually if you're doing debit spreads, you want to buy them because they're a lot cheaper, and you know the implied volatility is low and people aren't really freaking out, and it gives you a much better opportunity to take advantage of a good move while limiting your risk and also capping your potential reward. But a credit spread's often better when implied volatility is higher, when the VIX is higher, when there's more fear, and on a good pullback. Hopefully that helped some clear up some questions and help answer some answers. If it did not, or maybe just add more confusion, you can always reach out to me. I'm happy to help. Got a lot of articles, got a lot of videos on spreads, and of course, you're more than welcome to practice them, do some paper trading, and just see if they help your trading, see if you like them. Some people love them, some people don't. It just entirely depends on kind of your personality and oftentimes the way you're wired. Me, I'm just wired for shares. I like shares. Always have, always will. Tuesday is Tech Giant Tuesday. And while we're typing in the charts, I will answer my great friend Nancy. I'll answer her question. So you all are welcome to let me know what you want to look at on Tuesday. And as I'm typing these in, I will answer Nancy's question. CRM, WB, BZUN, Apple, Amazon, AMD, Netflix, Google, Facebook, MU, Square, AMAT, what? There we go. TW, TWLO. All right, Nancy says, what risk reward percentage do you look for on the spread? So the risk reward percentage is a great question. Risk reward percentage is really based on the debit spread. The credit spread is really just ROI. So the debit spread, I look for 1 to 2 or better. And a credit spread, since you're doing return on risk or return on interest, however you want to calculate it, but I'm looking at it as a return because your risk, Nancy, is pretty much always higher than your reward when you're doing a credit spread. That's another downside, if you will. The rewards and the probabilities are in your favor, but the risk is definitely always higher than the return. So I like personally to shoot for this 12 to 20% range for my target ROI when doing a credit spread. If it's more than 20, I'll just go farther away because I feel like that there's something weird out there going on, and it's usually better just to be a little bit safe and let the market kind of do its thing. And for debit spread, I like to go that more than a 1 to 2 risk reward ratio, which is actually not that crazy to get. They are pretty common, especially on the SPY if you buy and sell at the right times. Bob's, have a great night, everyone. Yes, you all have a fantastic and wonderful evening. My friend Joe, Matt DeLong, and myself, we're going to go to a gun range, shoot some guns, Then we're going to go out to dinner, have some snacks. Tomorrow we're going to go rock climbing, trade all day. It's going to be amazing. Ladies and gentlemen, have a great day. And until next time, love life, live life, trade.